Hello and welcome to today's video. In our last video, we looked at what the stock market is big picture. I explained why shares are one of the single most important inventions in human history. And today we begin to look at some of the most important considerations when it comes to actually investing in them. And arguably the first of these is the idea that you can invest in entire markets rather than in individual shares. As I've explained in many of our recent videos, getting involved with stock market investment is one of the highest probability ways you will become wealthy. That said, all too many people lose money when they do it. And there are many reasons for this, but I would argue that the main one is quite simply because too many people don't learn enough about it before they get involved. And one of the rookie mistakes so many people make is to invest in single shares or individual companies without understanding in any meaningful way how to do that. The evidence shows that a lot of investors only own a handful of shares. And nowadays, that might be something like one or two of Tesla, Facebook, Amazon, or Google, for example, or even worse, a handful of really high-risk small technology or software or mining stocks, which a friend has told you have great prospects. All too often, this is a very dangerous approach to stock market investment, and today we will look at why this is. So in my second book, Live on Less, Invest the Rest, I provided a list that I called a few of the things you probably need to know before you invest in a single company or a single share. And I'm going to share that list in this video now today to give you an idea of just how much you need to know and understand if you want to get involved with single stock investment. And by the way, just as a quick aside and as a reminder, we're only a few weeks away from publishing a significantly updated and upgraded version of Live on Less, Invest the Rest to help you with all of this stuff. And we'll be giving out lots of free copies of the ebook of that when we do. So please watch this space. But back to the list. Here it goes. Before you go anywhere near buying an individual share, you will be best served by producing a detailed investment checklist of all the reasons you want to buy that share. Let's spend a couple of minutes looking at what this sort of checklist should include. And please bear with me here. You might find the next minute or two quite boring and technical, but it's really important to plow through this stuff so you can understand in a really powerful way just how much is involved in single stock investing. And by the way, I'll post this list in full in the comments section below the video. Right, so first, you're going to need to understand and know a number of key valuation metrics. And these would include PE and EV/EBITDA ratios, return on capital employed, earnings yield, dividend yield, PEG ratios, and a fair bit else besides. In more complicated sectors like banks, insurance, or oil and gas, there are a whole raft of other specialist ratios you probably need to consider on top of those. Secondly, you'll need to be up to speed on what are called balance sheet metrics. These think about how much debt a company is using and the value of its various assets. And they'd include gearing ratios such as net debt to EBITDA and the current value of tangible and intangible assets on the company's balance sheet. And you will want to have a view on whether those assets have been valued appropriately. You will want to know the revenue, profit, and earnings numbers for the company and growth in those numbers, both historically and forecast. You will need to be aware of likely or potential company-specific news flow coming in the next year or so, and preferably an even longer time period than that. You should be thinking about the various macro factors which might affect the company, and those would include geopolitics, government changes, regulatory stuff, tax changes, currency risk, and so on. You'll also want to be mindful of what professional investors might call other exogenous factors. So what are competing companies doing? Is there a new technology or trend which could threaten the company's business? You'll want to think about M&A or mergers and acquisitions. Might the company get bought or might it buy other companies, thus potentially changing their numbers and business model possibly even overnight? And what about management? How good are they and how committed? Do they own lots of shares or not? And how much do they pay themselves and how much is that calculated? Next, you'll want to be aware of the company's position vis-a-vis stock market indices. Is the company part of an index? Might it fall out of that index? If it's not in an index, might it be included in one anytime soon? Because these considerations will create buyers or sellers from index investors. You'll want to have a think about what the current shareholder register looks like. How smart are the other shareholders? How long have they been involved? What sort of investors are they? Where are they based in the world? And you should probably know what the current short interest is on the company. What are the hedge funds doing? If you're really good, you should also know a fair bit about a number of various technical indicators for the company and for its share price. And these would include things like RSI, that's Relative Strength Index, MACD, Bollinger Bands, and average volumes of the company's shares traded over a certain period of time. Plus, you will probably want to have had a look at what forecasts are doing across most of all of these things that I've just mentioned. And very importantly, you should also have an exit plan. That laundry list of stuff that I've just trotted through could give you a reasonable measure of confidence to buy something, but how are you going to decide when to sell it? Most amateur investors literally never even think about this when they buy a share, yet deciding when to sell a share is arguably even more important than when to buy it if you want to make money. So let's pause for breath after that fairly exhausting list of complicated and technical stuff. How many people do you think know about everything that I've just gone through? In my experience, very few people understand this stuff or do this work prior to buying and selling single shares. And this is why stock market investment can be so dangerous. Make no bones about it, if you don't understand everything that I've just spoken about in the last few minutes of this video in real detail, and probably quite a lot more actually, you really do have no business at all making investments in individual shares. And at the very least, you should realize that if you do that, what you're doing is very risky indeed. Crucially, however, this need not matter and should not prevent you from getting involved in stock markets for the simple reason that you can buy the entire market rather than trying to learn all the stuff we've just gone through so that you can choose single stocks safely. For most investors, investing in an entire stock market is likely to be a far better option than learning the huge amount that you need to learn before you can invest in single shares with any level of confidence and with sufficient skill. Buying the entire market has a number of advantages over investing in single stocks. It does not require you to spend a huge amount of time learning about all the complex stuff that we've looked at so far in this video. It ensures that you're diversified across a large number of companies and industries. It takes very little time and effort generally. And it's also very cheap to do and tax efficient if you're using your pension and ISA accounts. The evidence shows that the majority of investors underperform the market. So why not just buy that market? This will increase the chance that you do better than most investors by definition. As veteran American investor John Bogle has put it, don't look for the needle in the haystack, just buy the haystack. To buy entire markets, all you need to do is understand what an index is and then how you get exposure to that index by using something called a tracker or exchange traded fund. In our next video, we'll look at this topic in more detail. I will explain what an index is, the plural of which is indices, by the way, and how you can buy really inexpensive funds which track those indices. We'll also cover off the fact that markets do crash, of course, and how you can limit the impact this might have on your finances. As I put it in one of my articles from a few years ago, we will look at how to invest so that crashes don't matter. And I look forward to seeing you then and covering this ground together. And for now, if you want to ensure that you're one of the first to see our videos when they're published, and as we go through the next few topics, please do click the subscribe and bell buttons, of course. And please do share these videos on your social media feeds if you share our belief in how important financial literacy is for everyone. Until next time, as ever, I wish you the very best.